All right, welcome to this explainer. Today, we're doing something a little different. We are stepping directly into the shoes of a lead examiner to show you exactly how to transform basic bookkeeping data into an absolute A-star performance. We're zeroing in on a crucial architectural requirement for the IGCSE 0452 exam, Sales and Purchases Returns Journals. So as your temporary lead examiner, I'm here to give you the inside scoop. Direct feedback on where students consistently bleed points, and more importantly, how you can lock down those top grades. We're going to look way beyond basic data entry and treat this as the fundamental bridge to high-level financial intelligence.
So here is our roadmap for today. We'll start with number 1, the A-star conceptual foundation. Then, move to number 2, technical execution and method marks. Number 3, ratio analysis and evaluation. And finally, number 4, the examiner's final checklist. Let's jump right in.
Section 1. The A-star conceptual foundation, modern terminology and principles.
Okay, to secure those top marks, we have to build a rock-solid foundation, and that starts with absolute precision in your vocabulary. You simply can't explain business health if you aren't using the right language. The crucial thing to remember here is that Cambridge demands 100% accuracy using modern international terminology. For example, if a customer returns damaged goods but later goes completely bankrupt before paying for their other items, well, we no longer call those bad debts. You absolutely must use the term irrecoverable debts. Likewise, it's owner's equity, not just capital. You also need to be crystal clear on the difference between accrued items, expenses you've incurred but haven't paid yet, and prepaid items, which are expenses paid in advance. Nailing these precise terms proves to the examiner that you're ready to tackle complex, multi-layered business scenarios.
Now, you must understand the duality of every single transaction. You always have to maintain this fundamental equation: assets equal liabilities plus equity. Let's use a simple, everyday analogy to understand the business entity concept. Think of the business as a completely separate person from its owner. If the owner grabs cash out of the register to buy their personal groceries, well, that's not a business expense. That's drawings, and it directly reduces equity. And what about when a customer returns goods? We record that in the sales returns journal. But how does that actually impact our equation? Well, our trade receivables, which are an asset, decrease, and our revenue decreases, which ultimately drops our owner's equity. Thinking through this balancing act is exactly what keeps your logic flawless when you're under exam pressure.
Here is a fatal error I see over and over again. Students often violate the prudence concept by just ignoring potential losses. Doing this completely distorts financial transparency. Prudence basically means you never anticipate a profit, but you always account for a probable loss. Let's say inventory is damaged and returned to you. The historical cost principle says you record it at exactly what you paid for it. But if it can only be sold for less than that cost now, prudence demands you write down its value immediately. If you overstate profits, you are literally misleading external bank audits and tax authorities who are relying on your accurate double-entry records.
Section 2. Technical execution and method marks, securing points.
So let's talk about how we take that conceptual foundation and turn it into actual points. This procedural flow is your ultimate roadmap. First, you identify the source document. For returns, this is absolutely critical. Businesses have to meticulously track credit note issuance to maintain a clear audit trail. Step by step, you reconcile these documents, record them in the books of prime entry, post them to the ledgers, and finally transition to the trial balance. Now, it's pretty fascinating. In the real world, modern cloud accounting software like Xero acts like an AI, automating a ton of this sales return processing by instantly matching credit notes to bank feeds. But in the exam hall, you are the AI. Examiners award method marks for showing this logical progression, even if your final mathematical balance ends up being slightly off. So always share your workings.
The T account remains the absolute gold standard of double-entry bookkeeping, and you must master distinguishing between the balance brought down and the balance carried down. The balance C/D, carried down, is the balancing figure at the end of the current period. It literally carries the balance down to the next period. The balance B/D, brought down, is the opening balance at the start of that new period. Getting these two mixed up is a wildly common recurring exam error. So here's a simple mnemonic to help you remember how to balance accounts under pressure. Dead click. Debit, expenses, assets, drawings. Credit, liabilities, income, capital. Keep your debits and credits in check using that, and your balances will just follow naturally.
You also really need to watch out for these common mathematical pitfalls where students just hemorrhage easy marks. For instance, there's a specific trick question. Actually, scratch that, it's more of a trap that we've seen in recent past papers. It involves a customer returning goods after a trade discount was originally applied.
Listen carefully, you must calculate the sales return value net of that trade discount, not at the original list price. Furthermore, you've got to show your workings for depreciation and inventory valuation. Failing to jot down your workings is basically just throwing away guaranteed method marks.
Section 3. Ratio Analysis and Evaluation. Mastering Assessment Objective 3.
All right, now we transition from merely calculating numbers into actually interpreting them. And this is exactly what Assessment Objective 3, or AO3, demands for that A-star response. Let's look at liquidity ratios. If your business's current ratio plummets from a healthy, optimal 2.5 to 1 all the way down to a super risky 1.1 to 1, well, simply calculating that drop is just a baseline skill. Interpreting why it happened is the real test. For instance, high volumes of sales returns will severely impact your net profit margins, and they'll drain your liquid assets if you've already paid out cash refunds. You always have to ask yourself, am I just calculating numbers here, or am I diagnosing the actual health of this business?
To really diagnose the health of a business, you have to evaluate the root causes behind the numbers. You need to ask high-level questions. Has inventory been overpurchased, which is tying up all your cash? Are trade payables being settled way too slowly, which damages your supplier relationships? Or maybe cash reserves are depleted because of a massive capital expenditure, like buying an entirely new delivery fleet. Connecting these dots, seeing the story behind the data, is exactly what an A-star accountant does.
Now, comparing different firms can be a bit of a trap because differing accounting policies mean you have to analyze the true quality of a reported profit. Take depreciation, for example. The straight-line method spreads the cost evenly over time, right? But the reducing balance method heavily charges those early years. So, if Company A uses reducing balance on a brand new IT system, their first-year profit is going to look way lower than Company B, who uses straight-line for the exact same system. As an examiner, I don't just want to see you plug numbers into a formula. I want to see you explain how these different methods literally change the yearly profit reports.
And please always remember that long-term sustainability and your return on capital employed, your ROCE, are heavily influenced by non-financial factors. We're talking about things like staff morale, your physical store location, and your market reputation. These things aren't recorded in your standard ledgers. If your sales returns are skyrocketing, yeah, your financial metrics will drop. But the non-financial root cause might be terrible product quality that's actively destroying your market reputation. You have to be able to bridge that gap between the ledger and the real world.
Section 4. The examiner's final checklist. Avoiding the pitfalls.
Let's look at some direct insider insights from the 2024 and 2025 Principal Examiner reports to shield you from the most common traps before you even walk into that exam hall. Examiners continually emphasize two silent killers of great grades, especially on Paper 2. First, terrible time management on complex questions. My golden rule? Allocate roughly 1.5 minutes per mark. Do not spend 20 minutes trying to perfectly balance a 5-mark ledger. The second silent killer? Poor handwriting. Seriously, if an examiner cannot read your balanced CD or distinguish your number 4 from a number 9, you lose the mark. It is literally that simple. Write clearly, especially your dates and your numbers.
Another massive point, you must firmly grasp the distinction between capital and revenue items. Misclassifying these completely breaks the integrity of your financial statements. Let's do a quick case study to visualize this. Capital expenditure is buying a long-term asset, right? Like a delivery van. Revenue expenditure is a routine day-to-day office expense, like putting fuel in that same van. And the exact same logic applies to receipts. A capital receipt is selling that old van. A revenue receipt is your day-to-day selling of inventory. If you accidentally record the sale of a van as everyday sales revenue, you artificially inflate your gross profit and you totally destroy the accuracy of your records.
So, as you prepare for your exam, I want you to keep asking yourself this absolutely critical question. Are you just calculating the numbers, or are you truly evaluating the long-term health and reality of the business? To think like an A-star accountant, you have to look well beyond the surface numbers. Master the modern terminology, show your workings to grab every single method mark, clearly separate your capital and revenue items, and most importantly, interpret what the data actually means for the business in the real world. Thanks for joining me for this explainer, and best of luck applying this lead examiner's blueprint to your own studies.